All right, welcome everybody to this month's stock market review. My name is Bennett McDowell with TradersCoach.com. Today is December 4th, 2024, and last one for this year. So the next one's going to be in 2025. So because I won't see you until 2025, I want to wish everybody a happy holiday and happy new year. Okay, Merry Christmas to everybody. All right, so let's dig in. Boy, markets are cranking, making new highs. It looks like almost like every week from now on, or at least in the last several weeks anyway. We're in the target zone for a major top, but there's no signs yet of this thing slowing down. We're going to take a look at a couple of the charts. I'm going to give you some support levels to look at and keep in mind, because if they get broken, then we have to start worrying about it. But right now, we're nowhere near them. So we're in pretty good shape. All right, let me go through some administrational items, and then we'll jump right in to what we need to get going with here. All right, first thing, if you wouldn't mind just taking a minute, whether you're watching the recording or with us here live today, give us a like, okay? That always helps. And we just want to also make you aware of the risks involved in whether you invest in the financial markets or actively trade in them. There's always that possibility of loss. There's no guarantees when we enter the markets. So you want to make sure you always enter the markets with money you can afford to risk, called risk capital. That's really important. And then you have to know how to do risk control when you actually trade or invest in the market. So if you need help with that, we can help you with that, but probably also your financial advisor can make recommendations on that. And you really should seek the advice of your financial advisor before actually doing anything in the market yourself. Just make sure what you do is suitable, all right? Because we don't know your personal situation. Your financial advisor does, so they can give you good personalized advice on that. All right, the other thing I want to jump in and look at is first the Dow Jones Industrial Average. And what I have in front of you here are three charts. I have a 60-minute chart over here. I have the daily chart here. And then I have the weekly chart here. And so the purpose of the 60-minute chart is to kind of give us a quick, short view of what's going on in the markets. And notice I have the same symbol. This just happens to be for the Dow Jones Industrial Average. But I can bring it up to the NASDAQ and the S&P and so forth, and will. But basically, all three charts are of the same symbol, the same market. And so this is a short-term look. This is kind of more of an intermediate-term look. And then we have the weekly giving us a more of a longer-term look at the markets. And so looking at all three is important. This is a form of multiple display, so to speak, of the markets, multiple time frames. And we kind of get a good overall picture of what's going on with the markets when we do it this way. So what I want to point out here on these three charts is everything is up. Short term, intermediate, and long term. So if I was going to give you a summary of what the market's doing, I'd say it's bullish short term, it's bullish intermediate, and it's bullish long term. End of story. Okay, so far the market has not at this particular point pulled back. Now these charts here are actually not live charts. I'm going to show you live charts in a moment, but these charts are drawn on Sunday of this past week. So they're kind of relatively new, but they don't take into effect this week's activity. And I will get to that in a minute. But as of going into Monday, you can certainly see, if you were looking at this on Sunday, hey, boy, it looks really good. Now, the next chart I want to show you also was done on Sunday. But the importance of this chart is a couple of things. One is that I've got some levels called support levels on the far right-hand side. And I've got three of them. I got one here, and another one here. One short term. Actually, I got two short term, and then one's a major support level. So why all these levels? Okay, well, if the market reverses and starts going below those levels, it may at that particular point start showing a change in structure. What does that mean? Well, the current structure is we're going up. So a change in structure would be now we're heading down. So that's why we look at those support levels to keep us attuned. Hey, are we in an uptrend, or have we changed now to a downtrend? So that's kind of the importance of keeping these support levels in check, because they're a quick reference for us to use for when the markets start to change. Now, obviously, as you can see, as of Sunday, there was no change at all. The support levels are nowhere near broken. And in fact, I've even drawn a variety of different trend lines on the market. I got a super short-term one up here. I got a longer-term one, or an intermediate, up here. I got another one up here, and then another really super long one down here. And again, market hasn't taken any of those out. We also have some of our software at work here. These are pyramid trading points that focus on price structure. And in this case, they're looking at support and resistance levels, drawing these triangles inside those levels, because those levels are also important to us as traders, because they represent breakouts and liquidity levels, and therefore take into account the fractal nature of the market. So we keep all that kind of in our back pocket and take a look at those. And as you can see, if we have our stops under here, we just simply trail them on up, okay? So that's kind of where we're at now. So right now, I'm just saying, as long as you have a stop in place, and no matter what you're trading, then that way you can lock in those profits if the market reverses. And it will reverse. It's, you know, they always do, okay? It's just a matter of when, not necessarily if. All right, a couple other things I want to point out on this chart is this terminology here where it says wave 5 target zone. What does that mean? All right, well, what we do is we go back to the beginning of the trend, and this trend actually started back in 2009. That's right, 2009, a long time ago. So Elliott Wave is a form of technical analysis where it actually assigns numbers to the different price structure in a trend. And if we go back to 2009, there are 5 waves in a trend according to Elliott. And we are at the 5th or last part of the trend, which is why this is called a wave 5 target zone. And this zone here right now, all right, extends itself up to 47,000, all the way from 40,281. There's another level above this that is also a possible area where the market could go. And I will show you that in just a minute as well. But for right now, that's the deal, all right? We're in the wave 5 target zone. It's not slowed down yet. We have not turned around yet. So enjoy the ride. That's the bottom line. Now, what happens when it turns around? What happens if it starts coming down? All right, well, then we got to pay attention. So if we start breaking this short-term support level, well, obviously, that represents profit taking. But if it keeps on going and breaks this area, which is a major support area on this trend up from here to where it currently is, then that's a break in structure, indicating that that particular trend is most likely over, and we may be starting into a more serious trend to the downside. They call that a bearish trend. So we're going to keep an eye on that. For all you liquidity lovers, there's a lot of liquidity sitting there. Now, what does that mean? Well, every time you get a pullback in a trend, what the retail traders are doing, or trend traders are doing, is basically putting their stops here. So what the institutions and the people that look to take advantage of the next move down, they like to run these areas and grab that liquidity and grab those stops on the way down. So we got to be kind of looking for that as well, okay? So we'll certainly see what that is going to entail. So if you were long this and you had a sell stop to take you out of the long position, then they would be buying that from you at that particular point. So that's kind of how that works. All right, so those support levels, keep in mind, we got 3, one at 41,647.30. We got another one at 38,499.27. And then a major one way down at the bottom here at 32,327. All right. And if we go below that, then that's a fairly good confirmation that we have begun the next significant bear market. And that bear market will probably last a good solid year or so. The interesting thing about the markets today, as compared to what they were 20 years ago, they move quickly. All right. So bear markets don't last as long as they used to a long time ago. So we may get a bear market here that could only last a year before it's over, compared to lasting several years back 20 or 30 years ago. So a little different. Things happen much faster than they used to. So be on the lookout for that. We'll certainly wait and see what happens. If this goes into a bear market, we could see significant price declines. Keep coming back here because we'll tell you what those are. But you're probably looking at around 50% retracement, which is quite significant from wherever the high of this thing ends, okay? So do keep that in mind. All right, the next chart is a shorter term chart. This is called a 60-minute chart. So every price bar here represents an hour. And the purpose of this chart is to just give you a quick glance at what's going to happen this week. So this here is indicating more movement up. We have bearish divergence between this high. So maybe we're in a 3-4 short-term 5 here. All right. So I would suggest as we work our way up, which is certainly what we've been doing this week, that when this ends, then we can expect a change in trend on over the next week or so. And if that develops into something more severe, we'll keep an eye on it. But for right now, it's in a bullish short-term target zone, looking around 45,720 for a top on this. And we are pretty darn close. We're going to look at the live charts in just a moment. All right, here is, let's see what we got. Here's the S&P 500. Just wanted to draw a trend line on this just to show you, just like the Dow, all the indexes are going in the same direction. Same thing with the NASDAQ. I mean, here's the NASDAQ. Okay, just making new highs, pumping along here. All right, now GBTC is a popular ETF for Bitcoin. So here we are with Bitcoin here on the ETF market. And again, screaming to the upside. If you recall here, we were talking about a great place to buy because this was a Fibonacci retracement area in here. So hopefully many of you did that. We're now in the target zone. We think it's going higher. But right now, it's a little more risky, obvious, to buy up here than to buy down here. I like to be a buyer down here, right? So I kind of, we're above the trend lines. Some people, of course, think this is going to go to the moon. Some people predict, in 10 years, it'll be $1 million. I can't predict that far in advance, so I don't know. But I am looking at some type of top here. Unless things change, we could get up to $100. We're what, 70? I think right now it's 78.65. This chart, we were at 77.09. And the actual Bitcoin market, too, is approaching its upper levels, too. So, again, here's Bitcoin market. As of Sunday, we're at what, 97,124. And tonight, we're at 98,679. So we're, even higher. So getting into the 100,000s, I think, is very likely. But we got to be careful here, okay? This is getting close to a top. And I would just simply draw a trend line. If we break the trend line, I would take some off the table, but that's me personally, okay? So, a lot of people trade the cryptos differently. They don't use charts. They use cycles and things like that. So whatever you use, that's fine. I use charts, and when I see it in a target zone, I start to look to make sure my stops lock in as much profit as it can before it reverses. All right, now a quick display on here on the real estate market. I do like to cover that as well. The real estate market in a nutshell is still in a bubble. All right, I've heard from realtors in California and those hot spots like that. Inventory spiked dramatically this winter. Home sales, there's many more houses for sale right now than actual buyers. I just saw this on YouTube from a fellow I follow in the San Diego area. They've had a spike, all right, in new listings, but the demand is not as high as it needs to be. So houses are staying on the market a little longer, and you're seeing prices, even though they're remaining high, prices are a little bit softer in terms of sellers have to now negotiate with buyers. So that usually results in prices coming down a little bit. And houses are staying on the market slightly longer than they were in the fall and summer, obviously, being winter. So we'll see if that changes during the spring. Maybe the buyers will come out and we'll see a different story. But here's what concerns me about the real estate market across the country. And if we take a look at this display in front of you, this chart, table, whatever you want to call it, this is the Case-Shiller price index versus the CPI. And the Case-Shiller real estate index measures the average price of homes across the United States. Now remember, real estate's very local. So your area may be slightly different than what the average is, of course. But what we want to look at here is the red line represents the Case-Shiller index. I'll just put CS. And this represents home prices, right? Average home prices across the United States. This black line right under it is the Consumer Price Index, also known as the CPI. And this measures inflation minus things like energy and so forth. Now, the chart itself goes back 50 years. So if we go back into the 1970s, way down here, the good old 1970s, gotta love the 70s, rock and roll, right? All right, so 1970s, we see that the Case-Shiller is pretty tight, pretty close to the CPI, but above it for the most sake, okay? In the 1980s, now, once the mid 70s to 80s came, it never went below the CPI. Now, why is that significant? Well, the reason for that is that you've often heard that real estate is a good investment, especially for young couples just starting out. It's a good place to start to begin and build wealth. So back in the 70s and 80s, in my era, buying your home was a big deal, okay? If you got a good job and you could get a mortgage, that was the first major step everybody took on their path towards creating wealth and, of course, eventually retirement one day. So real estate was an excellent investment, and it was, because it maintained a healthy distance from the CPI. So if you invested in real estate, you outpaced inflation is basically what that means. And that's what you want to do. All right, but there are times when the Case-Shiller index or housing gets overinflated, and those times are called bubbles. And we see it on this chart very, very clearly, because when the distance of the red line separates itself abnormally from the CPI, then we know we're in a bubble. And this happened to be the financial crisis. I'm sure everybody here remembers that. And that was that wonderful time in 2008 where they had all the HELOC loans, or basically any loan. If you could breathe, you could get a loan. So they had all these people buying homes that really couldn't afford it. Yet, home prices went up because of the demand. But then what happened is when the economy fell apart in terms of a recession, then nobody could afford their payments and the market went down. Home prices went down dramatically. You can see they went down about 50% from the high in 2008. Now, a couple of things I want you to take away from this. Notice how long this little crevice lasted back in 2008. Actually, it was around 2006 to about the end of 2008. The market back then was in a bubble. In other words, prices remained high, but it took a little while for it to break, okay? So there's been a couple movies about the financial bust back then, about people shorting the housing market and sweating it out because it didn't break, even though they thought it should. I think The Great Short is the name of a video famous for that, movie famous for that. But eventually it broke, and the short positions is on the real estate holdings made them a fortune. But it took a long time for that break to happen. So here we are today. All right, look at this. Where we are, go to the far right side of the chart. Look at the CPI and look at this distance now. Wow. I would say that's 2 times greater than the distance here. So what does that mean? I don't know about you, but that doesn't sound too good to me. So if you believe that the Case-Shiller index will eventually revert back to its mean distance above the CPI, that does not look good for real estate. You're talking, another 50, maybe even more decline in real estate for it to get back in line. So that's worrisome. Now, we're still in a bubble, all right? And again, we don't know how long this bubble is going to last before it bursts, kind of like back during the financial crisis. So the only point I'm trying to make here is that a lot of the assets right now, whether it's stocks, real estate, whatever, we got to be a little careful here. Even Bitcoin. Bitcoin is in the top realm of its target zone too. And I think, we're not selling off yet, but we have to think about maybe we're getting a little overdone here. Okay, so keep that in mind and keep an eye on it. So I'm a little concerned about the real estate market. I'm also concerned about the stock market as well. Once real estate breaks, it's so illiquid at that point that it usually trickles on down. And if you want to sell during a bad market, it's pretty tough. Whereas in the stock market, you call your broker up and sell it, and it's usually a lot more instantaneous. You might not get a great price, but at least you can get out. All right, so that's kind of where we're at on the real estate situation. I do like to take the time every month to cover that. This Case-Shiller index will be updated again. They update it, I think, about every quarter, every couple months or something. So this last update was not really, this was September, so we're due for a new one, but it's not out yet. All right, this is the interesting thing. One more thing on real estate here is interest rates. All right, so we have interest rates at 6.91% as of last Friday, and they went down to 6.29% in the middle of August to September. And even though they dropped interest rates, even though the Fed dropped interest rates, the mortgage rates went up. Go figure. I was like scratching my head on that one. Okay, I thought they would go down under 6, but they didn't. A lot of professionals in the mortgage industry think even if they lower rates, they're not going to go below 6. All right, so I think we're kind of stuck in this range of the mortgage situation. And that also caused buyers to pull back. And another reason why we don't see as many buyers right now as was hoped for in the real estate market, partially because of the seasonal time. It's getting into the holidays for one thing, but the interest rates are still bothering a little bit. Okay, so kind of interesting. All right, the real estate market is an interesting market these days for sure. All right, if you want more information on how to invest and trade in the markets, I've written several books. Elliott Wave Techniques is that trend analysis I was talking about, where you assign numbers to waves. And I wrote a book. It was published by McGraw-Hill. And it's a really excellent book because what I try to do with the Elliott Wave is simplify the process. Any form of technical analysis can get very overdone and very confused. So I always try to take a form of analysis and simplify it as best as possible. That way you understand it and can actually use it. All right, you don't have to come from MIT or something or Harvard to figure out how to use these things. All right, so Elliott Wave Techniques Simplified is a great book if you want to learn how to really use the Elliott Wave, yet not be overburdened by all the technicals involved in it. Okay, so definitely check that out. Risk Control is covered in Money Management for Traders, which is the book second from the right with a wad of $50 bills. And then I also have a Trader's Money Management System on the far left, which is a more actually in-depth study of money management. So again, if you want something simplified, that book second from the right is the way to go. Now, I'm really excited about the book on the far right. It says second edition, The Art of Trading. That's going to replace The Art of Trading on the left side. And the left side book it was published by Wiley. That came out in 2008. And Wiley's publishing my second edition here, and this will be out in January. And I put all the new stuff in there, everything, basically there's a lot that's changed in the market. It changes a lot every 10 years, not only the products you can trade, but also different forms of analysis, indicators, platforms you can use. So things change a lot. And computers have just expanded our ability to really get inside to the inner workings of price structure in the market. So the art of trading covers that, but covers also basically a lot of what you need to know to get involved in this business and figure it out. It covers some of our software in there. It's 608 pages, so it starts out for you knowing nothing and brings you up into the realm of being a professional trader, okay? So you may want to check that out. You can get it at Amazon right now. They have a special price for pre-ordering. I will put a link in the remarks area on the recording of this later today or tonight. And you can always go to our website at www.traderscoach.com for more information on that. And then, of course, same thing with our software. All those triangular pyramid trading points you saw on a chart, as well as our fancy indicators at the bottom. You can learn more about those, and I'll put a link again in the recording, okay, down below. All right, other than that, I just want to say thank you for coming. I want to take a real quick look at the Dow currently right now, and this is the live chart. We're at 45,047.50. We have an extended target up here that I want you to just look at for a moment. So if that other target gets exceeded, there is an alternate higher target between 47,427 all the way up to 59,107 that goes back a little further than the 2009 year. And this, while not the likely probability of where the market will end, it is a possibility. So I like to kind of give you that so you at least have that as well. And then, of course, the other indexes are screaming right along too. So they're all doing great. We can take a quick look at the, let's scroll down here a little bit and see if we can find the S&P for a moment. All right, maybe we'll take a look at the NASDAQ. So that has already reached its upper realm too. So all these markets, whether it's the S&P or the NASDAQ, they're all just been going straight up. You can certainly see that. No signs of letting go. I mean, look at this move on the NASDAQ over the last week, straight up. Okay, and you can see it still here, and you can certainly see it on this shorter term chart. Incredible. All right, and then we'll take a quick look at the S&P 500 as of today, and same thing. All right, so all these are screaming up. What I would do is stay level, keep a level head, keep your stops in place, because one day, not in the too distant future, the party's going to end. And so you don't want to get caught, all right, still buying, and then, of course, the market reverses on you, and then you have losses. So be careful here, okay? I would be very careful about taking any investment or long-term trades at this point. Short-term speculative trading, fine, okay? Go to it, all right, because you're going to be really watching those stops. But, do you want to get in here, or would you have rather gotten in here in the beginning of the year, okay? It's just risky. The higher it goes, the more risky it gets to the upside, because a reversal can come. So I'd be careful here. And again, we are expecting a big change in trend at some point, most likely in 2025. So keep that in mind. All right, so that's it for now. I'm going to see you all next month. I want to thank everybody for coming, and thanks for watching the recording. If you want to visit our website, once again, it's www.traderscoach.com. We have about 40 websites in terms of domains that point back to that website. So we also have one called appliedrealitytrading.com that specifically deals with our software. So you may want to check that out as well. We do a lot of coaching literally around the world. I've been doing this now for 30 years. So we've been in the business a long time. We've been in the space, as they say, a long time. We love what we do, and we really enjoy it. We enjoy working with everybody out there. So that's it. So have a great holiday. We'll see you back after the new year and after Christmas or Hanukkah or whatever you celebrate there. Just have a great one. Enjoy yourself with your families and be safe. And we'll see you back here next month. Thanks so much, everybody.